Hello everyone, this is group number 1 and we talk about Galaxy Lighting Case. This is the members of our group and there are our content. Then the next one please, we have to answer of the 6 inquiries. So we start with the decision-making process. This is, there is a different, there is a different statistics terms that we need. So one of them is break-even point to cover to represent that the number of units that the company has to sell in order to prevent the loss. So in this case, it's 4,166 units have to sell and it create a revenue. Then we have another indicator, which is volume and sales needed. So we project sales of 3,500 units, but unfortunately, this generate a loss of 80,000, which is in this point, the company have two options, or increase the price or sell more units. Then we have the safety margin, which is negative. It is a financial risk. So it's negative because the expectation units is less than the break-even point. And finally, the unit to reach the $2,000 in profit, the company have to sell 5,834 units. So the next one is about recommendation for the company. They have to implement aggressive marketing and also improve the sales strategy and the cost structure. The idea is to surpass the sales. No? Then they have to analyze in deeply to reduce variable costs and adopt higher margin prices strategy. And finally, the summary, the next one, please, is that the company want to decide to achieve greater profitability. The company needs to have two options to increase the price or sell more units. And also they show a negative safety margin. And this represent, unfortunately, a financial risk. If the company makes the better cost analysis strategy, this improve marketing and they will be sustainable. So continue, please, Shaira.
Yeah, hi. I'll be talking about the issues and solutions. Next slide, please. There are internal control weaknesses which might result in increase of probability of fraud and inefficiencies, and unaccounted inventory might result in delayed client responses and hence decreased customer satisfaction. There are a lot of financial challenges, for example, rising production costs and inaccurate budgeting, which has eroded and eaten the profit margins. Inaccurate expense budget, lack of break-even analysis, failure to define specific sales objectives result in overpricing and underpricing issues that are faced by GLI. Strategic expansion risks might involve entering into competitive residential lighting market, which has a lot of risks, like consumer preferences are very versatile and peculiar. The focus needs to be given on energy efficiency, the design and other features of the smart technology. Next slide, please. Then I'll be talking about the analysis of current practices, in which the first is internal control weaknesses. It lacks robust authorization processes, which results in vulnerability to the fraud and extravagant spending, which requires regular inventory checks that are crucial. Second is financial analysis and management gaps are there. Budgeting process is little outdated, which results in inaccurate forecasts, cost estimation, and expense management. Inventory management issues are also faced by GLI. And last but not the least, the strategic expansion challenges are there because GLI faces brand recognition limitation. There is lack of experience, operational inefficiencies are there, and for overcoming it, they need to partner with the potential developers and smart home integrators, which helps in growing the residential construction and remodeling the projects. Next slide, please. I'll be talking about the recommendations for the improvement, wherein there is enhancement of internal control systems in which they can implement multi-level approval processes and use software like SAP. RFID technology can be adopted as well to have the operational transparency. It is important to improve financial management in which they can use QuickBook tool. SAP Analytics can be used. Strategic expansion plan in which customer market plan can be understood in the pilot launch phase. Distribution channels need to be improved. Digital marketing can be adopted to focus more on the market presence. In risk management, it is important to address resistance to changes for which the change management strategies must be incorporated, and cost benefit analysis can be pre-implemented for the same. Next slide, please. I'll be talking about performance evaluation, in which RFID tracking system can be coupled with audits, and it will reduce the errors by 50% within 6 months by improving the inventory accuracy. GLI needs to sell 15,000 units, which cost $150 per unit within the first year to achieve the break-even point. And last but not the least, maintenance and enhancement of operation efficiency targets to reduction of overhead expenses by 10% in the initial year. So I'll be passing on to Sahil for his part.
Good morning, guys. My part is strategic analysis and recommendation for the Galaxy lighting. It's regarding a new Glow Home product line. The primary focus is on evaluating the decision between in-house and the outsourcing. This decision is critical because it impacts both the financial performance and operation efficiency of the company. In case our house production ensures full control, while outsourcing may reduce operational burden and cost. Choosing the right approach requires analyzing both financial and non-financial factors. Next slide, please. Like financial factors, like outsourcing involves pre-unit production cost of $145. This results in an annual production of cost of $507,500. On the other hand, in-house production through its maintenance, some overhead cost may offer operational control and potential better long-term returns. Next slide, please. About the non-financial factors and outsourcing costs. Overall control in-house production gives GLI full control over quality standards and ensure reliability and consistency. Outsourcing, however, introduces a risk of fluctuating quality, which could damage the company's reputation. Flexibility. Glow Home is highly customizable. In-house production allows rapid adjustment to meet the customer needs. Outsourcing may lead to delay and less control over production modifications. Next slide, please. I actually explained this slide. Can you just do next? Yeah, about the recommendation. After evaluating both financial and non-financial factors, outsourcing reduces cost and operational strain, but involves risk like loss of quality control and flexibility. In-house production, although costlier, ensures better quality management and product customization. Therefore, GLI needs to carefully balance short-term savings with long-term strategic goals. Next slide, please. I'll just give the conclusion. In conclusion, the choice between in-house production and the outsourcing is not just about cost saving. It involves balancing financial consideration, quality control, and the flexibility to ensure success for the new Glow Home production line. Thank you.
So I will talk about the flexible budgets and variance analysis for the GLI. GLI needs 3 different levels as planned, and we'll have flexible budgets for 3 different level activities. The first one is for 3,000, and the second one is 3,500, and the last one is 4,000 units. As you all see, in all 3 of them, the operating income is negative. The company is not making any profit, but the loss of income is decreasing while the number of products produced is increasing. So it means that economics of scales help GLI to improve their financials. But still, since they're not making any profit, they need to do whether good agreements about the costs, like purchasing, labor, etc., to reduce fixed and variable expenses. Of course, fixed expenses cannot be reduced in a short term, but in the long run, they can also be reduced. And also they can increase the sales price to make profit. So to deep dive, we will check the variance analysis. So the actual numbers are assumed. So for the 3,500 units, the sales revenue variance is 42,000 favorable, but the variable expense is 63,000 unfavorable. And even though the sales is more than the budget, the contribution margin is less than the budget because of the increased expenses. And also the operating income is also unfavorable, but the fixed expenses are 20K favorable, and which covers the variable expense increase. So when we deep dive, for the direct material, the total variance is 40K, almost 40K unfavorable, and the main reason is quantity. Even the price was good, the quantity was not. It means whether there's a quality problem or any inefficiencies regarding the production, because they used more quantity than they should have. And for the labor, both rate and efficiency was unfavorable. They found labors that they need to pay more than they expect, and they need more work hour than they expect. So there's an inefficiency in both sides, and the total difference is more than 60K. And for the overhead, there were no difference in terms of efficiency, but according to assumptions, of course. But for the spending, there was unfavorable variance. So it also need to be tracked, and the resource usage should be followed, or keep tracking the resource usage. So as a conclusion, there are inefficiencies in materials and labor, and also overhead as well. But the main problem in materials looks like a quality, and for the labor side, whether the assumptions are so bad or the problem is related to some inefficient process. So Deepika will continue with the cost management.
Thank you. Hello everyone, my name is Deepika. I'm here to present how GLI can achieve sustainable growth and market leadership while still overcoming financial challenges with the launch of new energy efficient product line, Glow Home. So let's look at the challenges. Like others have already explained, GLI specializes in energy efficient lighting solutions, and with introduction of Glow Home, GLI aim to penetrate the domestic market. However, the financial projections shows that the fixed cost of $500,000 in the break-even point for 4,167 units. The expected sales volume is like 3,500 units, which would result in 80,000 loss. So the challenges are like twofold. One is reducing cost to improve margin. Other is adopting sustainable practices to align with environmental goals and attract eco-conscious consumers. Solution will be for the GLI to address these challenges and then embrace sustainable cost management strategies. Next slide, please. The sustainability can be managed by various ways. One is the life cycle costing. This method evaluates the total cost of the sourcing, using and disposing of components. When initial cost may be higher, energy efficient components deliver long-term savings. Another one is activity-based costing. By tracking costs associated with green logistics, such as carbon emissions and cycling processes, GLI can identify high cost areas and optimized operation. The next one is flexible budgeting. So it can be like adjusting budgets based on activity levels and ensuring that they can align production cost with real demand and minimize losses. Next slide, please. When coming to sustainable operations and capital investment, GLI is also tackling sustainability at the operational level. It can do it through supplier optimization. So it can collaborate with suppliers to source affordable yet sustainable materials, will reduce variable cost without compromising quality. Another one is like doing the capital investment. To support the green initiatives, it is recommended leasing new equipments. Leasing cost of 1.7 million over 10 years compared to $1.9 million buyout. This approach preserves cash flow, mitigates obsolescence risk, and allows flexibility. Next slide, please. Yeah, so by implementing all these strategies, GLI will reduce costs through efficient supply chains and green practices. It will also be able to track the sustainability metrics such as energy usage and carbon emission to boost operational efficiency. And then it will also align with environmental goals while ensuring long-term profitability. Thank you so much. I would like to call upon Miho to continue.
Partial solar lease. Next, please. Those are detailed given information by GLI, but GLI doesn't mention about the interest rate for leasing, for the investment, and it doesn't mention about the lease payment. So we just assumed. Next, please. So calculation for comparison, cost for purchasing, loan payment, that's a total payment, 1,597,200, and that's assumed interest rate is 6%. Down payment is 300,000. Annual tax saving 45,000 based on straight line depreciation. Cost of leasing 1,520,000. And annual lease payment $160,000. Not given assumption. Those are the assumptions. And buyout payment, that's $200,000. And annual tax saving, $48,000, based on assumed lease payment. Next, please. So, lease option is more reasonable. No need for the initial cost of $300,000. If you have that amount of liquid funds, you should invest it. The total cost in 10 years will not be significantly different. However, maintenance costs and repair costs, those GLI doesn't need to pay. The leasing option is more flexible. In case GLI changes its product line in the future, it is easy to move to a new equipment. Technological advancements are rapid. In 10 years, today's new equipment may become outdated. Next one, please. So, Sheria, conclusion, please.
Okay, so finally, we have reached the conclusion. We have understood that GLI is at pivotal juncture with a new product line. The pricing strategies must be created for Glow Home line to be profitable. Flexible budgeting approach must be adopted to deal with the seasonal demand fluctuations and competitors' pressure. Outsourcing decisions must be carefully considered. It is important to transition to green energy efficient products that will be profitable. Insufficient internal control systems and stock and budgetary procedures must also be fixed by GLI. Improving the internal controls will bring more accuracy, reduce the fraud, enhance transparency and accountability of operations. So that will be all. Thank you so much on behalf of the whole group.